Assalamu alaikum. Welcome to this comprehensive presentation series, which will educate donors, board members, leadership, and the community on safeguarding funds and assets from potential risks and fraudulent activities within Muslim charities. This series of 17 videos of around 4 minutes each covers 15 critical segments, each structured into 5 vital subsections. Introduction to the video series on financial integrity and accountability in Muslim charities. What can go wrong in Muslim charities? Identifying common areas where misuse, fraud, and operational mismanagement may occur. What signs are indications of things going wrong? Recognizing early warning signs is key to preventing more significant issues. What are the remedial steps or actions to be taken? Addressing each challenge with actionable and practical solutions. What are the recommendations for managing the situation and improving performance? Implementing best practices to foster a culture of accountability and transparency. What are the best practices? Practical strategies to prevent future incidents and ensure operations align with Islamic principles. The 15 key topics covered in this series include cash donation fraud, safeguarding against cash mismanagement and unauthorized withdrawals, Zakat and religious fund misappropriation, ensuring that Zakat and other religious funds are used appropriately and transparently, financial statement fraud, identifying discrepancies and falsified financial records, expense and reimbursement schemes, detecting fraudulent expense claims and unauthorized reimbursements, vendor and procurement fraud, protecting against fraudulent contracts, inflated prices, and kickbacks, banking and wire transfer fraud, securing financial transactions against unauthorized transfers, payroll and compensation fraud, addressing payroll manipulation and unapproved bonuses, misuse of organization assets, preventing unauthorized use of vehicles, equipment, and resources, financial technology and cyber fraud, safeguarding digital systems against hacking and data breaches, board and governance fraud, upholding ethical standards and governance protocols, special project and construction fraud, monitoring special projects to prevent budget overruns and financial misconduct, religious program and special event fraud, ensuring fundraising and event expenditures transparency, grant and restricted donation fraud, verifying that restricted funds are used for their intended purpose, international activities fraud, managing overseas operations with due diligence and oversight, volunteer and community service fraud, establishing protocols to prevent volunteer-related fraud and asset mismanagement. Amanah, a sacred trust. This initiative is more than a series of videos. It reminds us of our Amanah, the sacred trust we hold in managing charitable assets. Honesty is not just a matter of avoiding wrongdoing, it is a conscious decision to act truthfully and transparently. Let us remember that honesty is not the absence of opportunity to deceive but the deliberate choice to remain truthful. Reflect, learn, and implement. We recommend you watch these videos individually, then convene as a group to view them collectively on a larger screen, followed by a reflective discussion. This approach will help you identify potential risks and warning signs in your institution and devise practical steps to mitigate them. Share, forward, and conduct training. Please look around and identify the people and leaders working in or for charities. Then, you can awaken them by sharing these resources or conducting training. A call for accountability and God consciousness. For those who may find themselves involved in questionable practices, we humbly remind you to return to the teachings of Islam, embrace taqwa, God consciousness, and reflect on the accountability we all share before Allah. Let's approach this with sincerity, transparency, and a genuine desire to safeguard our collective trust. May Allah guide us all in fulfilling our duties with integrity and sincerity. Section 1. Cash donation misappropriation or fraud. What can go wrong? Skimming. Individuals handling cash donations remove a portion before recording. Incomplete recording. Only a portion of cash donations are recorded in official accounts. Donation box theft. Unauthorized access to donation boxes. Juma collection diversion. Friday prayer donations not fully deposited. Ramadan, Eid collection manipulation. High-volume donation periods are used to conceal theft. Fake receipt issuance, creating false receipts for donors while pocketing funds. Collection counter-collusion, multiple individuals working together to misappropriate funds. Warning signs, donation amounts consistently lower than historical patterns or expectations. Discrepancies between amounts counted and amounts deposited. Broken seals are signs of tampering on donation boxes. Unusual delays in depositing Friday collection funds. Significant unexplained variances in Ramadan donations compared to previous years. Donors reporting donation amounts that don't match organizational records. Reluctance of specific individuals to allow others to participate in counting. Missing or out-of-sequence donation receipts. Cash handlers living beyond their apparent means. Remedial actions. Implement dual control. Always have at least 2 unrelated individuals present when handling, counting, and recording cash donations. Standardize collection procedures. Develop step-by-step procedures for handling cash from collection to deposit. Secure donation boxes. Install tamper-evident boxes and limit key access to designated individuals. Digitize donations. Gradually shift toward digital payment options that create automatic records. Investigate discrepancies. Promptly investigate any variances between expected and actual donations. Recommendations. Issue pre-numbered, duplicate receipts for all cash donations. Rotate cash handling responsibilities among different trusted volunteers. Deposit collections promptly, ideally same day or within 24 hours. Reconcile donation records with bank deposits weekly. Conduct surprise cash counts periodically. Install visible cameras in counting areas, with appropriate privacy measures. Best practices. Create a culture of transparency where financial matters are openly discussed. Provide regular donation summaries to the community without identifying individual donors. Train all cash handlers in proper procedures and ethical standards. Perform background checks on individuals handling significant amounts of cash. Compare donation patterns year over year to identify unusual trends. Maintain a clear separation of duties between those who handle cash and those who record transactions. Section 2. Zakat and Religious Fund Misappropriation. What can go wrong? Fund diversion. Zakat funds used for non-eligible purposes. Fictitious recipients. Creating fake zakat recipients to divert funds. Category manipulation. Misclassifying general funds as zakat to create flexibility. Sadaqah redirection. Using sadaqah funds for unauthorized purposes. Waqf asset misuse. Using waqf, endowment, property or income improperly. Qurbani, udiyah fraud. Collecting for sacrificial animals that are never purchased. Religious scholar exploitation. Using imam or scholar credentials to approve improper distributions. Warning signs. Unclear or missing documentation regarding zakat recipient eligibility. Zakat distributions to the same individuals repeatedly without a clear need. Inability to verify the existence of purported zakat recipients. Frequent transfers between religious fund accounts without a clear purpose. Declining to provide a detailed accounting of religious fund disbursements. Resistance to oversight of religious fund management. Lack of clear separation between different types of religious funds. Vague reporting on international zakat or sadaqah disbursements. Unusual or unexplained depletion of religious funds. Remedial actions. Establish clear fund categories. Create separate accounts for each type of religious fund, zakat, sadaqah, waqf, etc. Document recipient eligibility. Develop and implement clear criteria for zakat recipients based on Islamic principles. Create distribution committees. Form dedicated committees with religious and financial expertise to oversee disbursements. Maintain recipient records. Keep detailed, confidential records of all fund recipients and disbursements. Conduct regular audits. Perform periodic reviews of religious fund distributions and compliance with Islamic guidelines. Recommendations. Issue transparent public reporting on the collection and use of each religious fund type. Obtain scholarly guidance on proper fund management in writing. Require multiple approvals for disbursements above a certain threshold. Document the Islamic basis for fund classification and distribution decisions. Verify recipient identity and eligibility through multiple methods. Establish maximum amounts or frequency limits for individual recipients. Best practices. Educate the community about the proper use of different Islamic funds. Maintain separate bank accounts for each fund type when practical. Provide regular reports to donors about the impact of their religious contributions. Develop relationships with other organizations for cross-referencing assistance recipients. Create clear policies for international disbursement of religious funds. Regularly review religious fund guidelines with Islamic scholars to ensure compliance. Section 3 Financial Statement Misstatement or Fraud. What can go wrong? Revenue inflation. Overstating donation income to appear more successful. Expense manipulation. Misclassifying expenses to hide inappropriate spending. Asset overvaluation. Inflating the value of property or investments. Liability concealment. Hiding loans or other obligations. Fund balance manipulation. Misrepresenting restricted versus unrestricted funds. Related party transactions. Undisclosed financial dealings with board members or employees. Construction cost manipulation. Hiding the actual costs of building projects. Warning signs. Financial statements showing perfect or unusually smooth results. Frequent reclassification of expenses or revenues. Delayed or reluctant production of financial statements. Unexplained adjustments to financial records. Inconsistencies between internal and external financial reports. Complex transactions with unclear business purpose. Missing supporting documentation for significant transactions. Unusual growth in specific asset categories without explanation. Reluctance to allow board access to detailed financial records. Remedial actions. Engage independent review. Secure external accounting expertise to review financial statements. Implement accounting standards. Adopt appropriate accounting standards for nonprofits, e.g., GAAP, IFRS. Segregate duties. Ensure different individuals handle transaction approval, recording, and reconciliation. Document adjustments. Require written explanations and approvals for any accounting adjustments. Establish board review. Create a finance committee of the board to review detailed financial statements. Recommendations. Provide regular financial literacy training to board members. Use accounting software with proper controls and audit trails. Ensure transparency by sharing appropriate financial information with the community. Properly document and disclose all related party transactions. Maintain consistent classification of revenues and expenses. Clearly distinguish between restricted and unrestricted funds. Best practices. Develop a standardized chart of accounts appropriate for Islamic organizations. Create realistic budgets and regularly compare actual results to budgeted amounts. Establish whistleblower policies and anonymous reporting mechanisms. Conduct an annual external review or audit based on the organization's size. Present financial information in clear, understandable formats for the board and community. Maintain records that document the source and restrictions for all funds. Section 4 Expenses Reimbursement Schemes. What can go wrong? Fictitious expenses. Submitting false claims for reimbursement. Duplicate reimbursements. Submitting the same expense multiple times. Inflated expenses. Overstating the actual amount of legitimate expenses. Personal expense mischaracterization. Claiming personal costs as organizational expenses. Ghost employee payments. Creating fake employees or continuing to pay former employees. Vendor kickbacks. Employees receiving payments from vendors in exchange for contracts. Travel expense manipulation. Claiming excessive or non-existent travel costs. Warning signs. Missing original receipts for reimbursed expenses. Photocopied or altered receipts. Rounded expense amounts rather than exact figures. Pattern of expenses just below approval thresholds. Expenses that don't align with organizational activities. Multiple reimbursements with similar amounts. Expenses approved without proper documentation. The same person repeatedly approving of their own circle's expenses. Vendor addresses matching employee addresses or P.O. boxes. Significant increase in expenses without a corresponding increase in activities. Remedial actions. Establish clear policies. Create comprehensive expense and reimbursement policies with specific guidelines. Require original documentation. Accept only original, itemized receipts for all reimbursements. Implement approval hierarchy. Require supervisor approval, with no self-approval permitted. Set spending limits. Establish reasonable thresholds for different expense categories. Perform regular reviews. Conduct periodic audits of expense reports and reimbursements. Recommendations. Use standardized reimbursement request forms. Require detailed business purpose for all expenses. Pre-approve travel expenses whenever possible. Establish clear timelines for submitting reimbursement requests. Cross-check expense claims against event calendars and activities. Verify vendor legitimacy for significant or unusual expenses. Best practices. Provide corporate credit cards with strict usage policies instead of reimbursements when possible. Train all staff and volunteers on proper expense documentation. Maintain a master list of approved vendors and service providers. Regularly update policies to address new expense categories or issues. Compare expenses across similar events and periods to identify anomalies. Consider implementing digital expense management systems for larger organizations. Section 5 Vendors-related procurement fraud. What can go wrong? Shell company schemes. Creating fake companies to bill the organization. Bid rigging. Manipulating the competitive bidding process. Invoice inflation. Billing for more goods or services than provided. Phantom vendors. Creating fictional vendors for fraudulent payments. Halal certification fraud. Accepting payments to certify non-compliant products. Religious item procurement fraud. Overcharging for specialized religious items. Construction contract manipulation. Collusion with contractors on mosque building projects. Warning signs. Vendors with vague or generic service descriptions. Multiple vendors with similar addresses or contact information. Invoices with sequential numbers suggesting limited other business. Lack of physical address or only P.O. box for vendors. Vendor names like legitimate businesses but slightly different. Unusually favorable treatment of specific vendors. Resistance to changing vendors or putting contracts out to bid. Contracts are consistently awarded to the same vendors despite poor performance. Vendors only known to or vouched for by one employee. Construction costs significantly exceeding initial estimates. Remedial actions. Establish procurement procedures. Create clear processes for vendor selection and competitive bidding. Verify vendor legitimacy. Conduct due diligence on new vendors before approving payments. Implement contract review. Have qualified individuals review significant contracts before signing. Separate ordering and payment. Divide responsibilities for selecting vendors, approving purchases, and processing payments. Monitor vendor performance. Regularly evaluate vendor quality, pricing, and reliability. Recommendations. Require competitive bids for purchases above set thresholds. Maintain an approved vendor list with regular reviews. Check vendor addresses, phone numbers, and business registrations. Require conflict of interest disclosures from anyone involved in procurement. Rotate vendors periodically when appropriate. Document justifications for sole source contracts. Best practices. Establish a procurement committee for significant purchases. Create clear specifications before soliciting bids. Develop relationships with multiple vendors for key products and services. Implement periodic audits of procurement practices. Verify receipt of all goods and services before payment. Train relevant personnel in detecting procurement fraud. For construction projects, consider hiring an owner's representative. Thank you for watching. Please look for further videos on Charities University channel. Section 6 Banking and Wire Transfer Fraud. What can go wrong? Unauthorized transfers. Moving funds without proper approval. Account manipulation. Opening unauthorized accounts in the organization's name. Check tampering. Altering check amounts or payees. Signature forgery. Forging signatures on organizational checks. Wire transfer redirection. Changing the destination of legitimate international transfers. Online banking credential theft. Unauthorized access to online banking. International relief diversion. Funds sent for international aid never reach the intended recipients. Warning signs. Missing checks from organizational checkbooks. Unexpected or unexplained withdrawals or transfers. Bank statements showing unfamiliar transactions. Delays in receiving or unusual handling of bank statements. Unexpected changes to wire transfer instructions. Discrepancies between organizational records and bank statements. International partners are unable to confirm receipt of funds. Unusual timing of large transfers, especially near reporting deadlines. Login attempts to financial accounts from unusual locations or times. Remedial actions. Implement dual authorization. Require 2 approvers for all significant financial transactions. Establish transfer protocols. Create detailed procedures for wire transfers, especially international ones. Secure banking credentials. Limit access to online banking and use strong authentication methods. Verify recipient information. Confirm all new wire recipients through secondary channels. Reconcile accounts regularly. Perform timely reconciliation of all bank accounts. Recommendations. Use dedicated, secure computers for banking activities. Establish callback verification procedures for large transfers. Set up banking alerts for unusual activities. Limit the number of authorized signers on accounts. Keep a check on stock in secure, locked locations. Regularly update passwords and security questions. Best practices. Consider using positive pay services offered by banks. Maintain a log of all wire transfers with supporting documentation. Develop relationships with bank representatives who understand your organization. Conduct surprise reviews of banking activities. Ensure proper insurance coverage for banking fraud. Train relevant personnel on recognizing phishing and social engineering attempts. Consider using multi-factor authentication for all financial accounts. Section 7 Payroll Compensation Fraud. What can go wrong? Ghost employees. Payments to fictitious or terminated employees. Timesheet falsification. Claiming hours not worked. Unauthorized compensation. Paying bonuses or raises without approval. Benefit manipulation. Providing unauthorized benefits. Imam, religious staff compensation abuse. Providing undisclosed benefits or payments. Double employment. Staff receiving salaries while primarily working elsewhere. Volunteer reimbursement schemes. Paying excessive reimbursements as disguised compensation. Warning signs. Employees without complete personnel files. Missing or incomplete timekeeping records. Payroll checks with missing endorsements or unusual endorsements. Duplicate addresses, bank accounts, or SSNs, SINs among employees. Unusual increases in overtime or bonus payments. Payroll totals that don't reconcile with tax filings. Religious leaders receiving significant compensation from multiple sources. Resistance to payroll review or changes to payroll processing. Unusual patterns in employee expense reimbursements. Remedial actions. Centralized payroll oversight. Designate specific individuals responsible for payroll management. Separate duty elements. Divide responsibilities for adding employees, entering hours, and approving payments. Implement review procedures. Have someone independent of payroll processing review payroll before disbursement. Maintain personnel files. Keep complete employee records, including approved compensation levels. Conduct periodic verification. Regularly review payroll records for accuracy and appropriateness. Recommendations. Require board approval for all compensation structures and changes. Implement time tracking systems for hourly employees. Periodically verify employee existence and active status. Clearly document all special payments or benefits. Ensure payroll tax compliance and regular filing. Cross-check payroll disbursements against approved budgets. Best practices. Develop written compensation policies aligned with similar organizations. Perform periodic confidential reviews of imams and key staff's total compensation. Consider using reputable third-party payroll services. Conduct background checks on employees with financial responsibilities. Periodically review employee addresses and bank information. Create clear policies distinguishing employees from independent contractors. Establish transparent guidelines for volunteer reimbursements versus compensation. Section 8, Misuse of organizations' assets. What can go wrong? Facility misuse. Using organizational spaces for personal business. Vehicle abuse. Using organization vehicles for personal purposes. Equipment misappropriation. Taking or borrowing equipment for personal use. Supply theft. Taking office or maintenance supplies. Utilities exploitation. Using organizational utilities for personal benefit. Communication resource misuse. Using organization phones, internet for personal business. Walk property exploitation. Improper use of endowed properties. Warning signs. Missing equipment or supplies with no explanation. Unexplained increase in utility or fuel costs. Organization vehicles are seen in unexpected locations. The facility is used during unscheduled times. Unexplained wear and tear on equipment. Personal items are stored on organizational property. Resistance to inventory controls or tracking. Reports from community members about improper use of assets. Unusual scheduling of facility use with limited oversight. Remedial actions. Establish asset policies. Create clear rules regarding use of organizational property and facilities. Maintain asset inventory. Keep detailed records of all significant organizational assets. Implement checkout systems. Require formal checkout procedures for equipment use. Conduct regular audits. Perform periodic physical inventory counts. Monitor utility usage. Track and review utility consumption for unusual patterns. Recommendations. Create clear vehicle usage logs and mileage tracking. Set specific guidelines for facility usage outside normal activities. Establish procedures for approving reasonable personal use when appropriate. Implement secure storage for valuable or easily misappropriated items. Clearly mark all organizational property. Develop procedures for reporting missing or damaged assets. Best practices. Conduct annual physical inventory of significant assets. Create a culture where community resources are respected as Amanah, trust. Establish appropriate oversight of walk properties and assets. Consider appropriate technology for tracking valuable assets. Train all staff and volunteers on proper asset usage policies. Develop consequences for policy violations regarding asset usage. Regularly review insurance coverage for organizational assets. Section 9, Financial Technology and Cyber Fraud. What can go wrong? Donation page manipulation. Redirecting online donations. Phishing attacks. Fraudulent communications are used to access financial accounts. Banking credential theft. Unauthorized access to online banking systems. Fraudulent mobile apps. Fake apps claiming to collect for the organization. Social media donation scams. Unauthorized fundraising using the organization's name. Electronic payment diversion. Redirecting electronic donations to personal accounts. Database breaches. Theft of donor or financial information. Warning signs. Unexpected changes to the organizational website, especially donation pages. Reports from donors about unusual donation confirmation. Unexpected changes to online banking settings or contact information. Unusual electronic transfers or withdrawals. Donors reporting donations that don't appear in organizational records. Unexpected payment processing fees or new processing vendors. Suspicious emails requesting financial information or transfers. Community members reporting donation solicitations through unofficial channels. Unusual login patterns to financial or donor management systems. Remedial actions. Implement security protocols. Establish comprehensive cybersecurity measures for financial systems. Secure online donation platforms. Use reputable, secure platforms for online donations. Verify website security. Ensure donation pages use encryption and security certificates. Monitor digital channels. Regularly check for unauthorized fundraising in the organization's name. Establish data protection. Implement proper safeguards for donor and financial information. Recommendations. Use multi-factor authentication for all financial and donor systems. Regularly update passwords and limit access to critical systems. Train staff and volunteers on recognizing phishing attempts. Verify the legitimacy of all payment processors and online platforms. Regularly monitor online donation channels for unusual activities. Create procedures for responding to cybersecurity incidents. Best practices. Consider cybersecurity insurance coverage. Develop relationships with technology professionals in the community. Regularly back up critical financial and donor data. Create an inventory of all online donation channels and review regularly. Establish procedures for verifying the legitimacy of electronic donation requests. Stay informed about current cybersecurity threats affecting nonprofits. Conduct periodic security assessments of organizational technology. Section 10 Board and Governance Fraud. What can go wrong? Conflicts of interest. Undisclosed business relationships benefiting board members. Self-dealing. Board members directing contracts to their own businesses. Excessive compensation. Inappropriate payment to board members or executives. Loans to related parties. Improper loans to board members or their relatives. Financial statement manipulation. Misleading the board or community about finances. Unauthorized programs. Starting activities without proper board approval. Bylaws circumvention. Operating outside established governance procedures. Warning signs. Board members are reluctant to disclose business interests. Contracts or ventures benefiting board members without a competitive process. Decisions made without full board knowledge or discussion. Resistance to board oversight of financial matters. Unusual transactions approved with minimal documentation. Programs or initiatives launched without explicit board authorization. Selective information sharing with certain board members. Resistance to board rotation or term limits. Concentration of authority in too few individuals. Lack of appropriate committee structure or oversight. Remedial actions. Implement conflict of interest policies. Require regular disclosure of potential conflicts. Establish governance structures. Create appropriate committees with defined responsibilities. Develop board training. Educate board members on fiduciary duties and ethical responsibilities. Ensure proper oversight. Establish clear reporting relationships and accountability. Create term limits. Implement board rotation to prevent the entrenchment of power. Recommendations. Require annual conflict of interest disclosure statements. Establish clear approval processes for related party transactions. Create whistleblower protection policies. Ensure board minutes accurately reflect decisions and discussions. Develop succession planning for board and leadership positions. Maintain appropriate separation between governance and operations. Best practices. Recruit board members with diverse skills, including financial expertise. Provide regular governance training for board members. Create a culture of respectful questioning and transparency. Establish an independent audit or finance committee. Develop ethical guidelines based on Islamic principles. Ensure the community has appropriate input into major decisions. Schedule regular board self-evaluations. Section 11 Special Projects and Construction Fraud. What can go wrong? Project fund diversion. Funds raised for specific projects used elsewhere. Construction kickbacks. Receiving payments from contractors in exchange for contracts. Materials substitution. Using lower quality materials than specified. Change order manipulation. Unnecessary or inflated changes to original contracts. Progress payment fraud. Paying for work not yet completed. Contractor collusion. Bid rigging among potential contractors. Subcontractor schemes. Fictitious or affiliated subcontractors used to inflate costs. Warning signs. Significant deviations from original construction budgets. Numerous change orders or contract amendments. Poor quality work or materials despite high costs. Delays in construction without clear explanation. Contractors selected without competitive bidding. Close personal relationships between project managers and contractors. Resistance to independent inspection or verification of work. Substantial advance payments without clear justification. Lack of detailed documentation for construction expenses. Projects that remain perpetually near completion. Remedial actions. Establish project governance. Create dedicated committees for major projects with appropriate expertise. Implement budget controls. Develop detailed budgets with regular review and variance analysis. Verify contractor qualifications. Conduct thorough due diligence on potential contractors. Monitor project progress. Implement regular independent site inspections and progress verification. Control change orders. Establish formal approval processes for any contract modifications. Recommendations. Use competitive bidding for all significant contracts. Engage qualified professionals to review plans and specifications. Establish clear payment schedules tied to verified completion milestones. Document all project decisions and approvals. Implement regular project status reporting to the board and community. Verify materials and workmanship meet specifications. Best practices. Consider hiring the owner's representatives for significant projects. Maintain separate accounting for each major project. Establish clear lines of authority for project decisions. Develop relationships with experienced community members in construction. Create realistic contingency reserves for projects. Engage in a legal review of significant contracts before signing. Document lessons learned from each project for future reference. Section 12 Religious Programs and Special Events Fraud. What can go wrong? Ramadan collection diversion. Misappropriation during high donation periods. Hajj, Umrah program fraud. Collecting for pilgrimage services not delivered. Qurbani, Udiyah fund misuse. Money collected for sacrificial animals diverted. Religious education fee skimming. Collecting unauthorized fees from students. Marriage service fee diversion. Fees for nikah services not reported to the organization. Fundraising dinner manipulation. Underreporting attendance or donations. Speaker fee kickbacks. Receiving a portion of the fees paid to guest speakers. Warning signs. Unexplained discrepancies between event attendance and reported income. Cash-heavy events with limited financial controls. Resistance to having multiple people handle special event funds. Lack of detailed accounting for religious program expenses. Complaints from community members about services paid for but not received. Unusual patterns in seasonal religious activity income. Resistance to oversight of religious program finances. Limited transparency around fees collected for religious services. Special events with high expenses but low reported net income. Remedial actions. Establish program oversight. Create committees to oversee major religious programs and events. Implement event controls. Develop standardized procedures for event ticketing and cash handling. Verify service delivery. Confirm that paid religious services are actually delivered. Monitor special collections. Provide extra oversight during high-volume donation periods. Track program finances. Maintain separate accounting for major programs and events. Recommendations. Use numbered tickets for events and reconcile with attendance. Implement dual control for all cash handling at events. Create clear fee structures for religious services. Establish proper documentation for all program expenses. Develop transparent reporting of program income and expenses. Verify credentials and references for external speakers and service providers. Best practices. Provide regular reports to the community on program outcomes. Establish clear contracts with external speakers and service providers. Consider using electronic payment systems for event tickets and program fees. Conduct post-event financial reviews to identify improvement opportunities. Train program staff and volunteers on financial integrity. Create feedback mechanisms for program participants. Compare program financial results year over year to identify trends. Section 13 Grants, Restricted Donations, and Funds Fraud. What can go wrong? Fund diversion. Using restricted donations for other purposes. Double dipping. Getting multiple grants for the same project. Grant requirement evasion. Failing to meet grant terms while claiming compliance. Fictional program reporting. Reporting on activities that didn't occur or were exaggerated. Ghost beneficiary creation. Reporting assistance to non-existent individuals. Cost allocation manipulation. Improperly allocating expenses to restricted funds. Grant documentation falsification. Creating false reports or documentation for grantors. Warning signs. Inability to provide detailed accounting of restricted fund use. Frequent borrowing between restricted and unrestricted accounts. Delays in producing reports for donors of restricted funds. Vague or identical reporting on different restricted programs. Difficulty producing evidence of program activities. Lack of clear separation between different restricted funds. Significant unexplained transfers from restricted accounts. Statistical outcomes that appear too perfect or unchanged over time. Resistance to external verification of program outcomes. Remedial actions. Establish fund management. Create systems to track restricted funds separately. Implement compliance controls. Develop procedures to ensure adherence to donor restrictions. Document fund use. Maintain detailed records of all restricted fund disbursements. Create reporting systems. Establish regular reporting on restricted fund activities. Verify program delivery. Implement systems to confirm programs are delivered as promised. Recommendations. Clearly communicate with donors about fund use and restrictions. Maintain separate accounting for each restricted fund. Train staff and volunteers on the proper use of restricted funds. Establish approval processes for any use of restricted funds. Develop systems to track program outcomes accurately. Create precise documentation requirements for all grant-funded activities. Best practices. Consider using fund accounting software to track restricted donations. Provide transparent reporting to donors on the impact of their giving. Establish realistic program goals and measurements. Develop relationships with other organizations delivering similar services. Create internal audit procedures for restricted fund compliance. Train development staff on the proper solicitation of restricted funds. Establish ethical guidelines for program reporting and evaluation. Section 14 International Activities Related Fraud. What can go wrong? Relief fund diversion. International aid money not reaching intended recipients. Ghost organizations. Sending funds to non-existent international partners. Shell charity schemes. Creating fake charities to receive international transfers. Currency exchange manipulation. Reporting unfavorable exchange rates to conceal funds. Sanction violations. Sending funds to prohibited individuals or organizations. Documentation falsification. Creating false reports of international charitable work. Fee skimming. Taking excessive, administrative fees from international projects. Warning signs. Limited documentation of international partners or recipients. Inability to verify the existence or legitimacy of foreign organizations. Resistance to providing a detailed accounting of international fund use. Funds are transferred to high-risk regions without clear controls. International transfers to personal accounts rather than organizations. Unusually high fees or costs associated with international transfers. Lack of proper reporting on international activities. Limited or no photographic, video evidence of international work. Complaints from intended beneficiaries about aid not received. Transfers to countries unrelated to stated charitable purpose. Remedial actions. Establish international protocols. Create comprehensive procedures for international fund transfers. Verify partner organizations. Conduct thorough due diligence on international partners. Implement documentation systems. Maintain detailed records of all international activities. Monitor fund use. Develop systems to verify funds reach intended recipients. Ensure compliance. Establish procedures to comply with all relevant regulations including sanctions. Recommendations. Work with established, reputable international partners. Require regular reporting with photographic or video evidence. Conduct site visits when possible and practical. Use reputable financial channels for international transfers. Maintain detailed records of all international disbursements. Verify exchange rates used in international transactions. Best practices. Develop relationships with other organizations working in the same regions. Create clear agreements with international partners regarding fund use and reporting. Stay informed about relevant international regulations and compliance requirements. Establish appropriate risk assessment procedures for international work. Provide transparent reporting to donors about international activities. Consider working through established international relief organizations. Develop expertise in the specific regions where funds are being sent. Section 15 Volunteers and Community Services Fraud. What can go wrong? Service misrepresentation, claiming volunteer services not actually provided. In-kind donation inflation, overvaluing donated goods or services. Volunteer time manipulation, issuing false verification of community service hours. Food pantry, distribution diversion, diverting donated food or goods for personal use. Client assistance fraud, creating fictional clients to divert assistance funds. Community program fund misuse, using program funds for unauthorized purposes. Volunteer reimbursement abuse, claiming excessive or fictional expense reimbursements. Warning signs, suspiciously high reporting of volunteer hours. Limited documentation of community service activities. Resistance to oversight of community assistance programs. Unusual patterns in the distribution of community aid. Complaints about inequitable distribution of services. Missing or inadequate documentation for assistance recipients. Inventory shrinkage in food pantries or donation distribution programs. Repeat recipients of assistance without clear need verification. Resistance to implementing controls over assistance programs. Limited transparency in reporting on community service outcomes. Remedial actions. Establish service verification. Create systems to confirm delivery of community services. Implement distribution controls. Develop procedures for equitable distribution of assistance. Document assistance. Maintain appropriate records of aid recipients. Monitor program delivery. Regularly verify community service activities. Verify volunteer activities. Implement systems to track volunteer participation accurately. Recommendations. Create clear eligibility criteria for assistance programs. Rotate volunteers involved in distribution activities. Maintain inventories of donated goods and assistance items. Establish appropriate confidentiality protections for aid recipients. Develop objective systems for determining assistance levels. Verify new recipients through multiple sources when possible. Best practices. Create a culture of service and integrity among volunteers. Provide training on the ethical distribution of community assistance. Establish appropriate boundaries between providers and recipients. Develop relationships with other community service organizations. Implement systems for tracking outcomes and impact. Balance compassion with appropriate verification and controls. Regularly evaluate program effectiveness and community needs. Conclusion and key takeaways. As we come to the end of this comprehensive series, let us take a moment to reflect on the profound responsibilities we carry as stewards of community funds and assets. The topics we have explored, from cash donation fraud to volunteer and community service fraud, are not just operational risks, they are spiritual tests of our commitment to Amanah, the sacred trust entrusted to us. Act with vigilance and integrity. Fraud and financial mismanagement are not merely legal violations but breaches of our covenant with Allah and the community. Let us resolve to act with vigilance, transparency, and unwavering integrity. Implement robust controls, conduct regular audits, and establish clear policies fostering openness and accountability. Recognize and speak up. Do not remain silent if you observe any signs of wrongdoing, unusual patterns, or suspicious behavior. Speak up with wisdom and genuine concern for the organization's well-being. We must remember that concealing the truth only perpetuates harm and undermines the trust we are called to uphold. A spiritual reminder, the true measure of success. Ultimately, success is not measured by wealth or assets but by the integrity we maintain and the trust we protect. True success lies in preserving our honor and dignity before Allah. We pray that Allah protects our institutions, purifies our intentions, and grants us the strength to fulfill our responsibilities with sincerity, vigilance, and taqwa, God consciousness. A collective responsibility, a unified effort. As a final recommendation, we urge leadership, board members, and community members to come together, conduct regular review sessions, and discuss the insights from these videos. Implement the best practices, monitor potential risks, and maintain an open line of communication to address concerns promptly. May Allah make us trustworthy stewards. May Allah grant us all the strength to be trustworthy and accountable stewards of His blessings. May He guide us to uphold the highest standards of honesty and protect us from the trials of financial misconduct. Ameen. Jazakum Allahu khairan. Thank you for your attention and commitment to safeguarding our collective trust. Let us continue to work together to ensure that our charitable institutions reflect the values of transparency, integrity, and sincerity in all our actions. Introduction. Basheer Juma, a fellow member of the Institute of Chartered Accountants of Pakistan. 4 decades of experience in the accounting profession, including stints at PricewaterhouseCoopers, Anderson, and Ernst & Young. Former Office Managing Partner, EY Afghanistan, former partner, EY Ford Rhodes Pakistan, and former partner, Anderson Pakistan. Worked with PwC, Alexander Fletcher Ferguson and Company, in Pakistan. Former team leader of Islamic Financial Services Group and training and capacity building services of the firm. Speaker and trainer on time management, survival, and workplace skills. Delivered more than 100 presentations in various institutions. Advisor to A. NGOs, NPOs, CBOs, and social organizations, and B. Families in business for integration, transition, and succession matters. Author of over 30 books on self and time management, workplace success, family business, and not-for-profit. More than 1,000 videos on the above topics are available on Basheer Juma's YouTube channel. Books are available on Amazon. Email contact-basheer.juma@gmail.com. Here is a list of his books, available on Amazon and ekatab.pk. Family Business Related. Family Business Constitution Template A to Z of Family Business Harmony and Heritage Strategies for Thriving Family Business. The Role of a Mediator Beyond Wealth. Family Business Blueprint Workbook. Entrepreneurial Checklist. Family Businesses Best Practices. Family Business Sustainability Guide. Muslim Families Business Constitution. Self and Time Management Related. Highway to Success. Personal Organization Strategies for Empowered Self-Management. Strategies for a Productive and Purposeful Life. The New You in the New Year. Progress and Success. My Planner Now or Never. Organize Life and Manage Time. Time Management for Muslims. Workplace Skills. Soft and Critical Skills. Improving Performance Guidelines for Managers You Can Climb Up, for Students, Charities and Not-for-Profit Organizations. Essential Guide for NGOs and NFPOs. NGOs 100 Assumed Findings.